Here with me now, the Bear Traps Report founder and editor, Larry McDonald. Larry, always great to see you. Your take on where we are as we head into 2023. There are two schools of thought on this, that it's going to be a bumpy year, one, a tough year with the Fed raising rates and job losses to come, and others saying the Fed has engineered a soft landing. Everything's going to be okay. Your thoughts?
Well, when you do 450 basis points of rate hikes inside of 9 months, very few human beings on the planet Earth know what that's going to do to the economy 6 to 9 months later. Anybody that pretends that they know is really, kind of not that truthful. So the Fed doesn't know, and it's if you just look at autos, if you look at companies that face mortgages, lending tree, there's all these Capital One, any company that faces the bottom 60% of consumers, subprime lending, anything like that, even commercial real estate, there's just these pockets of real credit weakness that the deterioration speed is as fast as 2008. So although the jobs have been strong, and I think it's fantastic, but under the surface, the deterioration on the bottom 60% of U.S. consumers is 2008-like.
Let's talk a little bit about inflation. It's still running extremely hot. The Fed is probably going to have to continue to raise rates to try to tamp it down, 7.1%. Fed needs to get to 2%. So Jerome Powell has a long way to go. Having said that, you're also looking at a consumer that's very strained right now, as you mentioned, and we're seeing people, shift. They've gone through savings. Now they're going to put purchases on plastic and taking on debt, that kind of thing. The consumer, of course, represents two-thirds of the U.S. economy. So if the consumer pulls back, we're in for some trouble.
Yes, and what we're seeing is money is shifting out of U.S. stocks into global equities. So when you go from a long-term 10-year, maybe 20-year disinflation regime where inflation's coming down year by year by year, and when you go from that to an inflationary regime, a whole new ecosystem develops in the market where people want to, instead of wanting to own growth stocks, they want to own value because you can no longer trust growth multiples. In a disinflationary regime, people are willing to pay, say, 40 times sales for a company because the growth aspect of the economy is strong, and you look at, well, it may be 70 times sales next year, or so you've got companies in the last 6-7 years were going from 10-20 times sales to 30 times sales, and stocks were going up. Now in an inflationary regime, kind of like 1968 to 81, investors are looking for value stocks. Right. So that's where companies like Intel, that's where the outperformance is really going to be in 2023.
Larry, let me ask you about Republicans having a slim majority of the House. The hope on Wall Street is at least that they will be able to block any future spending. Spending is what got us into this trouble with inflation in the first place. Having said that, do you think that's exactly what we'll see? And do you think that they have any power to be able to try to make economic reform?
Well, in the waning days of the Bush administration, the national debt was about $8.5 trillion, maybe $9 trillion. This year, in 2023, this year alone, we have about $8.5 trillion of treasuries that are rolling over that have to be refunded. I mean, think about the breadth of what I just said. So the problem is we have so much debt, and we just did an omnibus bill in December. So the GOP it really is powerless to really rein in spending this year. They can next year.
Right. Larry McDonald, thank you so much. Good to see you.
Pleasure. Thank you.